Hey there. So my name is Dan Matuszewski. I'm a partner at CMS Holdings. CMS Holdings is a proprietary trading shop. For really all purposes, we operate the same way a traditional sort of investment, like a hedge fund or mutual fund or sort of a family office would. So we have no outside capital. So we trade all partner money. It's a name of a guy, Bobby Cho, Julian Sagan, who worked with me forever with Circle, and then myself. We got started about a year ago in October. So been doing that for a bit. And then previously, before that, I ran the OTC and liquidity operations for Circle, which sort of saw a lot of activity through the bull run. And then before that, I was at Kraken. So been trading crypto kind of as long as like you can be trading crypto. And what I wanted to talk about today is some best practices in the market, things that sort of you should be thinking about and looking, and then a little bit just sort of about the history of how execution services have changed in the industry since this like sort of all got started. So to really get into the nitty gritty of like what the two different like worlds are and how they've evolved is there's the primary cash market and there's the futures and derivatives market. And in that I'd lump in options. So this would be all the products that aren't directly sort of, I have cash, I want a coin, let's call it AVA because that's very timely. And I'm willing to give that amount of cash for that amount of AVA, and someone's willing to sell that amount of AVA for that much cash, right? So that's the simple model that everybody's like sort of used to. And in the beginning, this was dominated by a couple offshore entities, Mt. Gox being the biggest, Bitstamp being a huge one that's still around today. And then a bunch of brokerage type models, which at the time were like BitInstant was like a really big one. Coinbase started out in this model, right? So you went to them and they sort of acted as your broker. They didn't have an order book. They didn't have any lit pricing. They were just like, this is the price that we're selling at. This is the price we're buying at. Take it or leave it. Now, that was the world for many years. And it was the world for many years because that's the easiest version to do, right? Everything is fully backed and collateralized. And I mean that in the sense that if I deposit $1 million with Bitstamp, or today that'd be Coinbase Pro, GDEX, whatever they've branded it to at any given moment. And I take those dollars and I buy Bitcoin, and those people have deposited that Bitcoin on the exchange. And it's a very riskless transaction for everybody involved. Obviously, you're taking counterparty exchange to the sort of entity in the middle that's matching those orders, but there's not like a ton of risk with any leverage in the system. Everything is fully backed by both sides of the transaction, and it settles immediately. It's a ledger entry inside that matching engine. People are able to withdraw both sides of it after. Now, that's probably most of what anyone will ever deal with, if they even get to the order book and like sort of the matching side, right? The other way you can interface this is you just go to somebody and go, hey, I want to buy or sell X amount of Bitcoin, Ether, AVA, anything. And then they make you a price. You transact with them bilaterally, and then you swap sort of the assets. And this is all under the bread of what's really called spot, which is instantaneous transactions and settlement for both legs. Now, that's not the biggest portion of the market. This is it was though pretty much until I want to say early to mid 2017, where large levered instruments started to become the norm. Now, before 2017, there were a couple of venues that offered derivative products. The most popular one was clearly BitMEX. They came out, I think, in like 2013, 2014, but didn't get a ton of popularity really until mid to late 2017. But before that was a thing called ICBit, and there was OKX, which at the time was OKCoin. They had futures, and Huobi had BitVC, which had futures as well. So there were pretty heavy trading of futures activity in Asia. And then the US sort of had BitMEX come in, and futures really tended to dominate the landscape. Now, what are futures exactly? So futures are agreements like spot transactions, but nothing actually transpires, right? Like what you're really doing is you're taking risk sort of against somebody else. So you're being like, all right, I'll be long one future, like you'll be short one future, and nobody ever moves anything. We hold collateral with the venue, and we'll settle that out at a predetermined time in the future. That's like a typical future, right? This is how CME's products work. CME is the classic institutional where like oil, gold, copper, you name it, traditional commodity trades. And in that world, you're agreeing to settle that transaction in the future. Now, most of the time, nobody walks out in anything to settlement, meaning like people don't buy a Bitcoin future and then wait till settlement and like collect that. Some people do, but that's generally not the model that happens. And in fact, like the CME product is cash settled. So you can't even actually get delivery of it. You just settle into the cash value of a TWAP, which I think is the last hour of settlement. And cash settlement just means like nobody ever actually moves a Bitcoin. It's all just sort of betting on where the price action goes. Now, why are futures so dominant, and like, why does anybody even care about this? So the reason that they're super dominant is because you're not actually moving anything around, you're able to push the leverage in the system considerably. And we've seen this in crypto venues in particular get really jacked. I don't know who has the highest version of it now, but it's pretty routine to see 100, 125x, at least 50 to 25x on the longer tail of like alts. AVA trades with leverage on multiple venues, FTX, Binance. I believe Huobi also has like a futures product. So it's very common now to even see like new listings have futures sort of out of the gate, which is kind of wild considering that there were years we just traded Bitcoin with no futures at all. Now, the futures leverage changes things a little bit because especially when you have very, very high leverage with a very large retail participation in the base, people tend to lever themselves up a little too much, right? So they'll wind themselves up into positions that they can be liquidated on. And what it means to be liquidated on is if your collateral compared to your positioning is so high and that position goes against you, you'll chew through your collateral pretty quickly. And once you chew through so much of your collateral, the exchange is going to unwind you out of that position so that nobody loses any money, right? Like if you deposit $100 and you buy $1 million worth of Bitcoin and Bitcoin goes down 10%, you lost 100 grand, you only posted 10 grand. There's a 90 grand delta. So they're not going to let that 90 grand ever happen, right? Like, because then somebody else is going to be on the hook for it. So what they do instead is they will try to blow you out of that position quicker. Now they don't always can't, right? Like sometimes there's a gap move and like you're just not able to liquidate people out of those positions. And in the crypto venues in particular, there's a couple ways that they deal with this problem. There's what's called ADL, which is auto deleveraging, which basically means they'll force close the other side of the positions out in some manner. And then there's also insurance funds. So insurance funds are the venues will sort of collect a percentage of the transaction fees and put them in a bucket. And then that bucket will eat all the losses for all the liquidations that they can't deal with. But that's like a set amount, right? So like that amount of money, once it's gone, then they have to start socializing the losses. And when you socialize the losses, it means that you're basically taking away again from all the winners to eat like how the losers. Now, socialized losses are really bad. We don't see it as common now, but these were very, very common events with OKX and Huobi and like the original futures venues where liquidity was much poorer. Bitcoin's gotten very liquid now. There's a lot of participants trading it. You don't see that as much, but you will see like random sort of events happen in like the longer tail of like alt distributions. And that probably will continue to be the case as like you probably don't need 50x leverage on a token that's only existed for 3 months. And there's like probably a market maker, if that's out there like putting in prices. So you really do need to watch sort of how your leverage gets used on those venues throughout time. Especially like the newer stuff, there's just like a ton of gap risk. But those are the primary ways that the exchanges will protect against it. Now, BitMEX in particular, their insurance fund grew very large because they were a little too aggressive sort of in taking people out of position. So they ended up having, like in that scenario I described before, right, where you have $100 posted against $1 million of Bitcoin. They may blow you out of that position where you're like have $90 left. And if you do it versus 90 versus $95 left, then that $5 delta basically means that you were too aggressive in sort of unwinding that position. And because of that way that BitMEX had it structured is the insurance fund kept accruing value because that extra value would just go into the insurance fund. And the BitMEX insurance fund now is hundreds of millions of dollars. And it's a massive just pool of Bitcoin that's like been sitting there, which is just sort of an interesting little tidbit of like how this stuff goes. That's not the norm though. Like most of the cases, like these insurance funds tend to run pretty hot in the sense that like there isn't a ton of funds to be able to eat a loss, but exchanges also don't like to like broadcast that there's not enough there, right? Because that doesn't give you a lot of like faith in putting your positioning on. So anyway, back to my original point though, these are the two dominant models that you see like how stuff is trading sort of in the market now. Now, if you're looking to put a position on in AVA, ETH, Bitcoin, Polkadot, anything, there's a couple things you got to think about. one is like the venue you're going to want to use. Depending on what you're looking to trade, that decision might be made for you. There may only be a certain venue or two that supports what you're looking to do. In general, if you're going to use for a large execution, you're going to want to probably use a couple of different venues to sort of minimize your market impact. But let's just say, for instance, like you're going to use one. Now, if you're doing a spot transaction, it's fairly simple. You just deposit your whatever currency you're swapping out of, and you start sort of moving into it. Now, if you're looking to do things in the derivative side, there's a lot more complications in the sense that you have to start thinking about funding and financing related questions. Now, the dominant transaction method for futures is actually what's called the perpetual swap contract. Now, futures, as I had explained them before, were all these tenors that are listed further out, right? Like they'll settle in a week, 2 weeks, a month, and you sort of agree to like swap assets or like at price and index at that time. In the perpetual swap, there's no settlement. The contract just keeps going. And the issue with a perpetual swap contract is there's no settlement. There's no reason for the price necessarily to have to trade in line with the index, right? Like a quarterly future or a monthly or a weekly future always has to return to the index price because it settles to that index price. So there's always like a way to arb that thing and keep it in line because it has a defined end date. A perpetual swap contract doesn't end. So to make sure that that contract will always trade back in line with its index, there's this concept called funding. And funding is some periodic true up of the index to the current price of the future via some delta that it was trading at over like a lagging period. So what does that all mean in like layman's terms? It means that if you're long a futures contract that's trading above the spot price, you're going to pay funding because that's to encourage you to close your position or to encourage people to come in and like open shorts to bring the price back in line. And the funding it's scaled in sort of percentage terms of like how much you're paying as how like wide that delta is in any given point. And some of them cap it, right? Like a lot of exchanges will say like it's capped at 30 or 35 basis points or like 40 basis points. So it can't go any further than that. But the concept is still the same, is that like you're paying funding if you're pushing the index away from like the current price, meaning that if it's below index and you're selling, you're paying funding, and like sort of the same way if you're above index and you're buying. And that pushes things back in line. So like when you're trading derivatives in particular, you have to be very cognizant of like what these funding costs are because they can start to add up against you. I've seen funding costs for certain assets be the entirety of the, like, let's say contract's worth $100. You pay $100 in funding costs in like 2 weeks on it if you like don't pay attention. And this tends to happen really early on when there's new issuance and there's like not a lot of float, right? So we saw this with Filecoin. Filecoin lists on all the futures venues. Everybody thinks it's really expensive. They all have vesting that they want to hedge, and they're willing to pay a ton to be short, but they're willing to pay the actual value of the underlying over like the next, call it 2 or 3 weeks, just to be able to like hedge that out, which is crazy. So like you may be like, listen, there's a screaming short, like I want to sell it, but you got to be cognizant that like you may be just getting burned entirely out of your positioning. So you really need to pay attention to what those like funding costs are going to be over the lifetime of your position. Otherwise, you're going to be paying, you may be losing the entirety of the edge of like whatever you thought had. These are not concerns if you have to be trading spot vehicles, right? Because then settlement happens, you're done, you have it. There's like no defining thing that happens after that moment. The other big thing you want to pay attention to is what the curvature looks like, which means like what is the future in the forward look like current to the price. Now, things like AVA, right? AVA trades, it should trade pretty backwardated, meaning the future is below the current spot price. And that's because AVA has staking, which means that an AVA physical is worth more than an AVA in the future because an AVA physical can be staked and collect yield versus the AVA in the future, which is not collecting that yield. So it's like sort of the implied interest rate of the staking should be taken out of that. Now, crypto is kind of inefficient, so like that may not necessarily be true, but there's an arb there in the event that like that trades contango, meaning the future price is above the current spot price. So anyway, if all of that seems like very complicated and crazy, that should just be more the reason for you to probably stick to just spot transactions because it's a lot simpler. It's like makes a lot more sense. And you don't have to worry about all like the margining and paying attention to your positions and like sort of like events and like settlements. that would sort of be my takeaway for this whole thing for you guys. But anyway, that's the majority of how things transact in the crypto world, and how all the settlements and pipes and money move through the system. It's a big market now. There's a lot of players. There's billions of dollars moving. It's very much changed from the couple $1 million that would move across like random venues back in 2012, 2013.